Welcome to HTLF Retirement Plan Services. We are the third-party administrator and trustee for your retirement plan. Today, I will ask you to use your imagination and determination to start or keep moving toward your retirement goals. We will show you why it's important and how to do it. So let's get started. For today's meeting, we're going to discuss why it's important to focus on retirement saving, provide you with a broad overview of retirement plans and key features associated with them, provide you with basic information on investments so that you can make an informed decision, outline online tools and resources to help you manage your retirement plan, and finally, outline how you can obtain information about your plan's specific features. We all have different ideas of what our retirement looks like. For some, it might be right around the corner, and for others, it might be 40 years away. It comes much quicker than you realize. Close your eyes and try to visualize being retired. For some, it's traveling to exotic locations, while for others, it may be as simple as being able to stay at home and focus on hobbies. Many of us will not be world travelers, but instead traveling to see kids or grandkids. Maybe having the flexibility to work part-time or volunteer. The choices you make now will help you have those options in the future. By offering this plan, your company is giving you a chance to realize that retirement, and we're here to help. How are you going to support that retirement vision? You might be surprised to know that according to the Social Security Administration, the average retiree will have 33% coming from Social Security. Did you know that in 2019, the national average for Social Security's monthly benefit was approximately $1,470 per month? To see what your monthly benefit is projected to be, you can go to ssa.gov and log into your own account. It's important to periodically review your Social Security statement, as you want to verify your recorded earnings to be sure they are correct, as they affect the amount you could receive. Only 20% of the income is from employer-sponsored or individual retirement plans, requiring the average retiree to supplement 27% of their income by continuing to work. We want your decision to continue to work in retirement to be a choice rather than a requirement. In order to do that, you will need to ensure that your retirement plan or other saving vehicles can help support that gap. So how much will you need? Well, it's likely more than you think. As people are living longer and things are becoming more expensive, there are many hurdles in retirement which may derail your retirement plans. Although you cannot plan for all unexpected events, we want you to be aware of the challenges that face retirees today. Consider that people are living longer, and medical expenses, especially costs related to assisted living and long-term care facilities, continue to grow. You want to make sure that you have enough to cover whatever may come your way. Thinking about what you may need, this chart is based on retirement projections completed by the GAO, or Government Accountability Office. It outlines the amount you should have in your retirement based on your age. By the time you are in your 30s, you should have twice your current salary saved towards retirement. 3 times your salary by the age of 40. The national average, however, shows people age 40 have only $45,000 saved. 4 times your salary by 45, and 6 times your salary by age 50. However, the national average says that people age 50 have $63,000 in their account. That amount should be $240,000 based on a $40,000 salary. By the time you are retirement age, you should have 10 or 11 times your salary saved. The national average shows $117,000. Hopefully this chart will give you a better idea of how much you should be saving throughout your working career. You can see from this the numbers keep growing, but as I mentioned, the national average is the same. People are not saving enough for retirement. It's time to act now and get on track. Your employer-sponsored retirement plan can help. Why are these retirement plans such a great place to save? Let's look at the many advantages your plan has to offer you. Participation and enrollment is easy. The money that you authorize your employer to defer will come out of your paycheck automatically. If you're like most people, if you don't see it, you won't spend it. Through pre-tax deferrals, you could save taxes on every dollar you put in the plan, because you will not have to pay taxes on your contributions until you withdraw them. Depending on whether you contribute to your plan on a pre-tax basis or after-tax basis, which we'll cover later, your earnings will grow tax-deferred or tax-free. The magic of compounding interest helps your account grow exponentially over time. Retirement plans also offer a variety of investment choices. These investment choices offer you the opportunity to choose from a wide range of investments with varying degrees of risk to meet your individual needs. You will have full discretion over how your savings are invested, And of course, we offer tools to help you select the investment choices that are right for you. If you retire or leave the company for some reason, the account balance is portable. You can maintain your tax benefits by rolling the account over into a new company's plan or IRA. Now I want to point out some key features of a retirement plan. Note that these are for overview purposes and may not be available in your plan. Generally, to become eligible to participate in the plan, you must meet certain requirements such as age or time with the company. Some plans may have specified entry dates, like the first of the month following your eligibility. Most plans have stipulations around how much you can contribute to your 401k. In this example, you can deter up to 25% of your annual salary up to an IRS limit. If you are over the age of 50, you may be eligible to make a catch-up contribution above and beyond the standard IRS limit. You can reference the summary plan description to get specifics associated with your plan. These documents are available within our website. For most plans, there are two ways to contribute to the plan: pre-tax or Roth. Pre-tax is the traditional method of lowering your taxable income by the amount you put in. The contributions and the earnings grow on a tax-deferred basis until withdrawn. At that point, you pay the taxes based on your tax rate at the time of distribution. The thought is you might be in a lower tax bracket in retirement, so let's defer those taxes as long as possible. Roth deferrals are a little different. You don't receive a tax deduction when they are made. There are no initial tax savings. You pay taxes on the amount of contribution at the tax rate you're in when contributed. However, as long as you don't withdraw money before the age of 59 and a half, and have contributed to the Roth over 5 years prior, all the earnings on these contributions are tax-free. You won't pay taxes when the money is withdrawn, so the tax rates at retirement don't concern you. Generally speaking, the younger you are and the more time to invest, the better the Roth may be. Your tax rate at a younger age may be lower than in the future. If you're looking to reduce your current taxes, the pre-tax election may make more sense. It's a personal choice based on your situation. Again, reference your summary plan document to understand your specific plan contribution options. Let's look at an example of what this means. If someone earns $1,500 per pay period and does not make a contribution, they are taxed on all $1,500. Now, if someone earns $1,500 per pay period and makes a pre-tax contribution of $90, that reduces the taxable income to $1,410. At a 25% tax rate, the amount of taxes owed would be $352.50 in taxes. Please note that contributing the same dollar amount of $90 on a Roth after-tax basis, the amount of taxes owed would still be $375 in this example. The other main difference, remember, is how the $90 is going to grow. In the pre-tax example, if the $90 grows to $900, taxes would be owed on the whole balance when it's distributed. In the Roth example, taxes have already been paid on the $90, and the additional $810 in growth would be tax-free. No matter where you are in your working career, it's never too late to start. The earlier you participate, the more choices you'll have later. To illustrate this, we have 3 people who start working for the company and participate at different times. Michael and Megan listen to their recommendations and start contributing right away at age 21. Henry, realizing he has a lot of time until retirement, doesn't start until 15 years later. Michael reaches 35 and stops contributing because he has other things to take care of. So, in that 14 years, he has contributed almost $42,000. Megan pays herself first for the entire time and puts in almost $138,000. Henry knows he will have to contribute more and puts in almost $96,000 for the remaining 32 working years. Now we see the magic of starting early and compound interest. Megan, by contributing early and often, is clearly in the best shape for retirement. She is just under $1 million at the age of 67. The surprising difference comes from Henry and Michael. Despite contributing over twice as much as Michael, Henry's balance is now $342,000 versus over $600,000 for Michael. That is the power of compounding. Jumping in at the full amount can be difficult, so if you start at a smaller number, you can creep up to a higher deferral rate by adding 1% each year. You barely notice the additional amount. So if you start at a smaller number, you can creep up to a higher deferral rate by adding 1% each year, and you barely notice the additional amount. For someone making $30,000, a 1% increase is $11.54 per paycheck. That is one less combo meal each pay period. Not only will you lose weight, but you will also accumulate additional assets in your retirement account. Think about it. After 20 years, that could be an additional $16,000 in your retirement account. My challenge for each of you today is to log into your account and make a tiny change to your deferral. That will make a huge impact on your retirement savings at retirement. Consider reviewing your spending habits and then decide what you need and what you could do without. Where will you find the extra funds? It seems like a small price to pay for a long-term reward. Let's look at a few examples. If you buy 3 gourmet coffees a week that cost $4 each, see what your retirement balance could be if you invested that $12 into your retirement plan instead. A movie for 2 with popcorn and pop could run you $25. Check out your retirement plan balance if you decided not to go to a movie each month. Instead of spending $27 a week having lunch at a fast food restaurant, look at how much you could have in your retirement plan if you brought your lunch instead. It's amazing how much you can accumulate if you contribute $50 a month to your retirement plan rather than going out to dinner twice a month with your significant other. You may not be alone in this journey. Not only do employers offer a plan to help you prepare for retirement, but some sponsors will also encourage participation in the plan by adding an employer contribution. Should a sponsor elect to offer some sort of employer contribution, typically they come in 2 forms: contribution matching or a discretionary match. In this example, the company will match 50% of your contributions up to 6% of pay. Think about it. If you put 6% of your compensation, they are giving you 50% return on investment. The employer dollars are taxed like pre-tax dollars when withdrawn from your account. In addition to your own contributions, some employer may make an additional discretionary profit-sharing contribution at year-end to help your retirement savings grow even faster. Please remember that this contribution is discretionary. The company will decide at the end of the year if such a contribution will be made. For those of you that are eligible but perhaps not participating in the plan, you need to take a close look at this feature. Essentially, the contribution from your employer is free money, and if you're not participating, you're leaving that money on the table. Please refer to your summary plan description for more information to determine your plan options and if your company offers some sort of employer match within your plan. Assuming your plan offers a match is not simply money in your pocket now. It's money that compounds over time to multiply your retirement savings. In this general example, a 30-year-old employee with $30,000 annual salary getting a 50% match on their 6% contribution is equal to an additional $95,313 in this employee's retirement account. I understand that this may not be a real-life example, and performance is going to fluctuate. However, it is intended to demonstrate the powerful effect a match could have on your future self. We know the concept of investment can be an overwhelming feeling. To help you with determining how you may want to invest, we have provided you with several tools that can help guide you through this important decision. One of the first things that are important to learn is understanding your risk tolerance. We have an investment questionnaire also found in our employee enrollment guide that is designed to provide an asset allocation that might be appropriate for you. Remember, your asset allocation decision is an important one and should be made for the long term. The examples of actual past returns are not a guarantee on future results. They are provided for illustration purposes only. Upon completion of the questionnaire, you will have an overall score. Using this score will provide you with suggested investment mix models. The sample models show the approximate ratio of different asset classes that correspond with the number of points you scored on your investor questionnaire. You can use the information to help you determine a mix of investments among these options in your retirement fund menu, or you can apply your own investment strategy. As you determine your allocation, keep in mind that diversification is an important element in retirement investing success. To understand the funds that are available within your fund lineup, you must understand how funds are classified and the risk-reward factor that may come with them. This table outlines general fund classifications and provides a high-level overview of types of investment methodologies that reside within them. Funds on this table progressively get riskier as you move to the right. See the chart for a better overview of the risk-reward. It will be important for you to understand this and compare it to the results of your investment questionnaire, as well as the funds available within your plan. If we could guess what the market was going to do every year, we wouldn't be sitting here today. I would be somewhere on a beach with my feet kicked up listening to the waves. This quilt chart illustrates why it's so hard to determine which asset class is going to outperform the others. Let's take a look specifically at the years 2017, 2019, and 2020 emerging markets category, which is the pink box. In 2017, it was the top in performance, and in 2019, it dropped to the bottom. In 2020, it went back up again. As you can see, it can go from the best return to the worst return in a year or two. Spreading out your risk across different types of investments will increase your odds of investment success. If we diversify, even if one asset class is doing poorly, we have another picking up the slack. Diversification is important in investing because markets can be volatile and unpredictable. Your ideal asset allocation is the mix of investments, from most aggressive to safest, that will earn the total return over time that you need. The mix includes stocks, bonds, and cash or money market securities. As you determine your allocation, remember diversification is an important element to ensure your entire portfolio is insulated from the ups and downs of a single stock or class of securities. The percentage of your portfolio you devote to each depends on your time frame and your tolerance for risk. Each portfolio satisfies a particular level of risk tolerance. The goal is to minimize risk while meeting the level of return you expect. For those of you who may not want to determine your investment allocations, the investment industry created target date funds that help you take the guesswork out of investing and may be used as your primary investment vehicle. So, what are target date funds? When asked how to invest, we educated you to, number 1, be diversified, and number 2, make sure your risk is appropriate for your age. The target date funds do both of those for you. Target date funds are designed to simplify investing for retirement. The target date is typically expressed as a year. Find the year that's closest to your anticipated retirement date offered in your retirement plan, and that's the fund for you. Simple enough. A target date fund invests in several asset classes. That's one of the advantages of investing in a target date fund. It diversifies your retirement investments. When you invest in a target date fund, you avoid being overinvested in a single investment option. As the target date approaches, the target date of the fund's investments become more conservative. In general, the idea is to take more risk and potentially earn a larger return, while the target date is far in the future, and to take less risk as the date gets closer, so as not to risk big losses and to preserve capital. Now that you know key things about your retirement plan, let's get you access to your retirement plans with HTLF Retirement Plan Services. You can access your retirement plan via our website at www.htlfrps.com and click on the login link. You will be granted access once you meet your plan's eligibility requirements. Please refer to the Participant Enrollment Guide. This guide will help you through logging in for the first time. The website is htlfrps.com. When you arrive at the site, you will select the Login option button in the navigation bar. For first-time users, select First Time Logging In above the login fields. Enter the plan password that was previously provided by your employer or local HR department. Upon entry, you will be prompted to proceed through the new user steps, including setup of your username and password. Please refer to our Login User Guide if you have questions. Once you are logged in, please review your profile to make sure your email and phone number are up to date. These will be critical for a secure multi-factor authentication if we need to communicate with you in the future about your retirement plan. Once you log in, you will land at the dashboard. The dashboard will contain most of the information you're looking for, including balance, allocation of investments, contribution amounts, and recent transactions. As part of completing your enrollment, you will make changes to your investment allocation and contribution rate from this screen. The items on your website menu include Manage, which is where you go to make changes to the amount being contributed as well as the allocation of your funds. Performance will show you how you've done over whatever periods of time you'd like. And Personal information will allow you to add email or phone numbers and to add or update your beneficiaries. Don't forget to set up your beneficiaries once you have set up your deferral rate and investments. We have provided some valuable tools to support you in determining your retirement readiness. Within the Tools section of our website, we have 2 key features to consider. The Retirement Calculator. Use the Retirement Calculator to estimate your income and savings that you will have when you retire. The results will identify if your current savings will last through your retirement years and show you a cash flow and estimated balance for each year. Educational videos are also available for you to watch at your own convenience by visiting htlfrps.com/individuals/financial-education. Once you are enrolled and participating in your retirement plan, you may consider rolling funds from another retirement plan with a former employer into your new retirement plan. Some of the benefits of doing this would be your money will continue to grow tax deferred, all your accounts are consolidated for simplicity and convenience, and you avoid paying early withdrawal taxes and penalties. If you are interested in requesting a rollover, please reach out to us so we can help you get started. Information related to the specifics of your plan can be found in the following areas: your summary plan description, the HTLF Retirement Plan Services website, or you can connect with a Retirement Plan Services professional to learn more. Based on what you've heard today, I want to challenge you to take some action. Are you ready to take control of your money? Log into your account through our online portal that provides a wealth of resources and tools at your disposal and allows you to have real-time access to see how your money is performing. If you're not already participating in the plan, take the first step to your retirement future and enroll in the plan. A little saved today can make a difference at retirement. For those that are participating in the plan, I encourage you to review your financial situation and determine what changes you want to make to your plan. Consider increasing your contribution amount, select your investment options, update your beneficiary information, and verify your email address and contact information. Thank you for your time today. Our team stands ready to serve you through your retirement journey. If you have any questions or concerns, please feel free to reach out to our office at 1-800-399-2083 or visit our website at www.htlfrps.com.